2008, the financial crisis hits. Wall Street's finest, analysts with Ivy League degrees, traders with decades of experience are in full panic mode, bleeding losses. And yet, somewhere across America, a group of everyday people who had just started investing 6 months earlier, they beat them. How? They did absolutely nothing. Think about what an expert's day looks like. Hundreds of data points, earnings reports, Fed announcements, geopolitical signals, analyst calls. So why do they lose? Because they know too much. Experts are always searching for a reason to sell. Rates are rising, earnings missed, recession indicators are flashing. So they move, buy, sell, rebalance, hedge. Every single move costs them. Transaction fees, taxes, mistimed entries. The beginner, they bought Apple or index funds and forgot they owned it. That forgetfulness became their strategy. Ever heard of Peter Lynch? One of the greatest fund managers in Wall Street history. His Magellan Fund returned 29% annually for a decade. But here's the twist. He once said, "Half the people who invested in my fund still lost money because they bought high, panicked, and sold low. The fund won. The investors lost. Same fund, opposite outcomes." Why? Emotion. Professionals feel pressure in ways you don't. Their bonuses, their reputation, their clients' trust, it's all on the line every single day. That pressure distorts judgment. You don't have a boss breathing down your neck. You don't have quarterly performance reviews. You're scared, so you hold. You don't know what to do, so you wait. And that ignorance and patience becomes your edge. Let's talk about the S&P 500, the 500 biggest companies in America. From 1980 to 2020, it returned an average of 11% per year. Now, what did the average retail investor make over the same period? 3.7%. Same market, same opportunities, nearly 1/3 the return. The only difference? They kept moving. The person who bought an index fund in 1980 and never touched it, full 11% every year, compounding. Put $10,000 in at 11% for 40 years, $650,000. Put the same $10,000 in at 3.7%, $41,000. That's a $600,000 gap, created not by smarter picks, but by doing less. Here's the one thing I want you to take from this. The biggest risk in investing isn't ignorance, it's overaction. Stop feeling inferior because you're not a finance expert. That's not a weakness, that's your weapon. Buy a great asset, then leave it alone. Turn off the news, close the charts, go live your life. That's the one move Wall Street professionals can never make because their job won't let them. But you can. Next video. So what exactly should you buy? And no, the answer isn't what most people think. Subscribe and stay tuned. No fluff, no generic advice, just the stuff they don't tell you.